creating wealth, freedom, and security using real estate investing. This is Get Real Wealthy. You're watching Get Real Wealthy. On this episode, we're going to talk about the differences between getting a residential mortgage and a commercial mortgage. All right, so I get questions sometimes about what it's like getting a residential mortgage versus what it's like getting a commercial mortgage. I've got a ton of residential mortgages in my life, and I've had lots of success and lots of trials and tribulations, and I've been focusing on commercial mortgages since 2015 as I focused on apartment buildings more. The residential space, when you're looking at mortgages and getting mortgages for your rental properties, they're going to look at the debt coverage ratio on the actual rents that you get. They're going to look at your income. Where is the income coming from to actually pay it on top of the debt coverage ratio? They're going to look at your credit history, your credit record. They're going to look at tax records from the last few years. So the residential space, I consider that taking a residential property and you're really doing a lot of work to be able to get that. Sometimes the amount of files that I had to send to get a residential property, I remember going to the bank once when they had everything in paper, and they had one of those big filing cabinets, and one of those filing cabinets was just for me. So that's how many files, because they kept all the leases, they kept all the records, they had paper copies of everything. So it can be very cumbersome. What about commercial properties? Commercial properties are very different because the way that you would get a mortgage on a commercial property is based on the fact that the commercial property is a business, and they are looking at overview of the building and being able to support the loan of the property. Okay, so that's what they're looking at. Does the building support the loan on the property? If it does, they'll give you a mortgage based on how much that building can support. If you're looking at conventional, sometimes a conventional lender will come back, and a conventional lender is like a regular bank lender, one of the big 5 banks. They'll come in and they'll give you a loan maybe with a debt coverage ratio of 1.1. Based on the net operating income of the building. That could mean that you are actually getting a 60% or 65% loan on a commercial building, 5+ units, okay? So it's a little different. But they are looking at the building. I would say in some cases 75%, and then the other 25% is you. So what are they looking at for you? Well, they want to look at that you're paying your taxes, that you do have like a decent credit report, but also that your net worth usually is a little bit higher than the value of the building. Now, every lender is going to be different and their criteria is going to be different. That's why I suggest talking to your banker, talking to your mortgage broker in order to find out what they're looking for. But typically, the building takes priority in commercial, and in residential, it's the person that takes priority. And that's what the qualification is like. So depending on what you're doing, commercial or residential, it's going to depend on either the building or more on you, depending on the type of mortgage that you're getting. I hope you like this little short on commercial versus residential and getting those mortgages. We'll see you on the next episode of Get Real Wealthy. If you want to learn more about me and find out what I'm doing on my projects, visit quentindesouza.com. All right, see you on the next episode. Make sure to check out getrealwealthy.com. Until next time, I'm Quentin D'Souza. Get out there and take action. The views and opinions expressed in this podcast are provided for information purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to getrealwealthy.com.